Hi, this is Brad Wolff, and this is the end of day Emini review. Today was a sell climax that led to a trading range. On the open, the market gapped up, and you had a buy climax going into yesterday. Buy climax here, here, and here. So it increased the odds of an opening reversal and a sell off to the moving average. This was also a sell climax, which led to a trading range. So you had big up, a big sell climax, big down, and then sideways. Typically on the open or any point of the day, when you see a big rally and a big sell-off, traders expect sideways. Big sell-off, big rally, traders expect more sideways. First bar of the day, it's a doji. By the third bar, it's reasonable to buy, betting on trend resumption up. However, a lot of traders are going to be very quick to exit. It's already 3 pushes up. 1, 2, and 3. 3 bull bars that were consecutive, it was reasonable to expect another leg up. However, when this bar went above the high 1 here, that was the third push in an already overbought market. Therefore, traders would be very quick to exit as this bar turned down or went below here. Any bull that was long, it was reasonable to exit below this bar. There was also, this was low probability. If you look at the range as a whole, the range was probably going to expand. It was obviously going to be bigger. So when the market started to rally, traders had to wonder if this was actually going to be the low of the day. More often than not, the market goes below the initial low and above the initial high. So at this point, on this bar down, traders expected some sort of measured move down. So bear breakout, another follow through, probably sell the close, closing below the high of this bar. Traders will sell this close. They'll sell here. They'll sell here. They would even sell this high 1. The problem with selling below this high 1 right here is it's a nested second entry, high 2, high 1 here, high 2 here. The context is also bad. It's forcing traders to sell after a large buy climax. Typically, when you get a large buy climax, the market goes sideways. It's the opposite of this, a large sell climax bar. This is a large sell climax. Whenever you get a large sell climax, you typically expect sideways for a few bars. Big sell climax, typically expect sideways. The other problem with selling below this bar is it's a micro channel. 1, 2, 3, 4, 5, 6 bar micro channel. Selling below this bar, you know the market's more likely than not is going to reverse. Therefore, it's a low probability sell. If traders did sell it, they would likely exit as the bar started to turn up. It's a low probability sell. Bulls, they will buy knowing bears take profits. They'll buy here. They'll buy above here. They'll even buy this high. Why not buy this bar right here? Well, the problem with buying this bar is it's a wedge top. 1, 2, 3. It's also testing the entry point for the bears. Bears sold below this bar. It was where bulls also got trapped. Any bull that bought the low of the day or here, they're going to likely use this bounce to exit. The other problem is risk reward. If you buy above this bar, where does your stop go? Well, it's somewhere down here. And if you're buying up here and your stop's down here, you have a bad risk reward because your stop is all the way down here. It's basically this blue box, and your target, 1 times your risk, is all the way up here. That leads to a bad risk reward trade. Traders will buy it and scale in lower, although I think it's better if most traders look to buy lower. Bulls exit below here. Aggressive bears might sell, but this is too tight. Better to wait for a trendline break. Trendline break retest in the form of a wedge top. Bears sell here. Bulls certainly get out there. Any bull that bought the trend resumption here, disappointed by the doji and the weak follow through, they would exit below here, and the market got another push down. By this point, you've had 2 legs down, leg 1, pullback, leg 2, and complex bottoms. Wedge bottom, and then a wedge pullback, and then another wedge bottom. It was reasonable for bears to exit somewhere around here, above this bar, certainly above here. Bulls would go long. It's also a retest of this high 2 buy right here. This was a credible buy signal, although the channel was tight. And here's the retest point. bulls will buy here, bears will exit. Any bull that bought here, 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 they could buy betting on a second leg. However, for the rest of the day, it went sideways, which is trading range price action. By the time you get to here, it's best to assume that you're going to be in a trading range. And even if the market breaks to the upside, it's still going to be within this range over here. Therefore, when the market has 2 or 3 legs, traders sell. When the market gets a bear breakout, traders look to sell a pullback. And once there's another leg down in the form of 3 pushes, 1, 2, 3, traders are quick to buy back shorts and bulls are quick to buy. 3 pushes up, 1, 2, 3, bears look to sell, bulls exit longs, and the market goes sideways. If you enjoyed this video, please go to the brookstradingcourse.com website where you can find more information on the video course, view recent blog posts, as well as read the forums. If you would like to see live commentary, please go to the brookspriceaction.com website where you can find out more information on the trading room. Thank you for watching this video.